My friend Raj lost 99% of his investment. You know how? He invested in a really good company, one that all analysts were talking about, one that posted stellar revenue growth and profit growth, one whose management was ambitious, qualified, and confident about the company's future. Raj was a smart investor. He read the financials, the annual reports, and then made his investment decision. So what went wrong? All the reports and data that Raj read were fraudulent. They were fake. Imagine this, the company's annual reports being a literal lie. That's exactly what happened with Satyam back in 2009. What would you do if you were Raj? And how would you avoid this? How do you make sure that the information that you see is real and not made up? My name is Aaditya Iyengar, CFA. Welcome to Personal Finance TV. Today we learn about the biggest accounting fraud that India has ever seen and how you can find the red flags in the companies that you have invested in. Back in 1991, a 4-year-old company, Satyam Computers, got listed on the Bombay Stock Exchange. And that's not all. In just 10 years, this company would go on to list on the New York Stock Exchange. The company was in the business of offering software development and system maintenance services, and they had a steady business model in the IT-rich landscape of India. Get this, out of their 600 total clients, 185 were Fortune 500 companies. They were almost at the pinnacle of their success. However, at this time, the city of Hyderabad, the exact city that Satyam was based out of, saw a real estate boom. And the founder of the company, B. Ramalinga Raju, started investing in real estate to make more money. Initially, he started with whatever money he had, and then his family's savings, and then finally with the shareholders' money. But wait, it's not that easy to steal money from a company, even if it's your own. So how on earth did Raju pull this off? It's actually very simple. Let me teach you how accounting can be done creatively. Because if you want to catch a thief, you need to think like one. So today we'll do exactly that. Only for research purposes, however. I'll give you an example. A company like Spotify sells you a prepaid annual subscription for 1200 rupees a year. Now, they get 1200 rupees from you today, they got the cash, but they didn't earn this 1200 rupees yet. What does that mean? Even though you paid for a yearly subscription today, the revenue of 1200 rupees can only be recorded when Spotify gives you the music streaming service for the entire year. So legally, Spotify will record 1200 divided by 12, meaning 100 rupees of revenue every single month. But if the corporation wants to fool its shareholders, they could just say, you know what, we earned 1200 rupees in revenue today. This is called accelerated revenue recognition, and it's just one of the many ways that you can falsify accounts. So if Satyam earned 100 crores in a year, they did everything in their power to make it look like they earned 1000 crores in profit. But why? Stock manipulation. When Satyam reported incredible numbers, the stock price would go up. And this is exactly when Raju and his friends would sell some of their holdings at an inflated valuation. Or they would simply pledge these shares as collateral and borrow money from a bank. The loan would be least of their concerns if the stock price kept going up. Because think about it, if you have a stock that costs 10 rupees, you give the stock to the bank and borrow 8 rupees against it as a loan. The bank would be overjoyed if the stock went to 100 rupees. Because now that lowered their risk. If you don't repay your loan, the bank would simply sell that stock and make all of its money back. Now, if you wanted, you could borrow a fresh loan of 80 rupees against the new valuation of 100 rupees. You would repay your 8 rupee loan and not worry. And do you know the best part? You do not owe any taxes to the government under this arrangement because debt is not taxable. So Raju thought, if I do this and acquire a ton of money, buy real estate in the booming Hyderabad market, I'll make even more money. Then if needed, I can just use this profit to repair the books of Satyam and make it look like all the profits were real and nothing ever went wrong. And mind you, Raju's plan was actually genius. He also had access to a lot of insider information on the upcoming government initiatives in Hyderabad. Information related to highways, metros, railways. But how did he access that? All credit to the incredible relationships that he had built with the government, which offered him access to various ministers at any time of the day. Now, when shareholders ask questions about where the profit went, Raju would simply fabricate fake bank statements and say that the profits are safely invested in various bank FDs. This went on until 2008. The stock price kept rising and Raju kept on pledging his shares or selling them at higher profits. And then what? Timing is a make or break kind of a thing for every single person. 2008 happened. Real estate, much like other assets, collapsed and Raju's plan of using the real estate profits to repair his company's books failed. He also tried to do some more creativity by trying to make it look like all the profits were used to acquire two companies called Metas Infra and Metas Properties. Metas, by the way, is just Satyam but the other way around. These were the two companies that Raju created to acquire real estate and try to make more money. Basically what he did was try to do a fake acquisition. He thought that if he makes it look like he used all of the profits to acquire these two companies, the books would automatically get repaired. The shareholders are asking where's the profit and Raju says I used it to buy these two companies. Now during this entire time, PricewaterhouseCoopers audited Satyam and didn't do much. However, the acquisition was when the investors had enough. It got called out by several people, journalists and his own board members. This event finally led to Raju admitting to his crimes in a letter. He confessed to overstating Satyam's asset by a whopping 7,800 crores. That was 94% higher than what they actually were. This confession also led to PwC being fined $6 million in the US by the Securities Exchange Commission, 14 crores in India, and it was further barred from auditing any Indian firm for 2 years. So the big question that every investor should have after listening to this story is, how on earth do I know that the financials I see are real? How do I know that the management is acting in my best interest as a shareholder? How do I know that there is fraud in my investments? It's actually really not that hard. There are two solutions that you can follow to understand if the companies that you're investing in are fraudulent. If you're someone who loves investing in direct stocks, you need to read the management commentary and the footnotes of any annual report. These talk about the assumptions made during accounting, the judgments used, and the important things that you need to know. Oftentimes, managements will only highlight their biggest wins in the first few pages of annual reports with vivid graphics, and the human tendency is to only look at these and assume that everything is okay. You remember accelerated revenue recognition that we just mentioned? The footnotes may provide significant hints as to whether this kind of business is going on in the company. You could simply copy-paste the footnotes in ChatGPT and ask it to explain it to you like you're 10. Easy peasy. On the other hand, let's say you are a beginner and aren't that comfortable with accounting practices or investing in direct stocks, the best way is to stick with mutual funds and ETFs, since these are managed by large institutions who have the means and the power to question managements and keep them on toes. Always remember, at an annual meeting, the word of a large shareholder like a mutual fund has a lot more weight than the word of an individual shareholder like you and me. Anyway, what's a red flag that you've found in your investments? Let us know in the comments below and consider leaving a like and subscribe to Personal Finance TV if you learned something new.